Can anyone hear me? Am I clear?
Yeah, you can go ahead, George.
All right. So I'll be sharing my screen. Okay. So, good day, everyone. I'm George Ikechukwu from Team One of the Prestige Ads Program. Uh, trying to share my screen.
Okay, please, George, do note that you have 15 minutes for your presentation and your time starts
Sorry,
now.
I'm trying to set it. Okay, as I said, John, everyone. This is um, A from Sage Labs, Self Analytics Sage. Again, our mentor for the project was Tracy. For our topic was analyzing the economic impact of construction in the South Africa. First, we see our executive summary where we are talking about the research and what is research. Our research here examines applications, quantum fraction features in Uniswap ecosystem, and it focuses on gas fee sponsorship impact over the last 90 days. So our key findings include gas sponsorship increases. We found out that it increases user participation and trading volume. We found out that it creates economic trade-offs for liquidity providers and it transforms run and eliminates MEV extraction strategies. And note recommendations for optimal gas sponsorship models were provided in our work. So, introducing the project, ran a background, we ran a background of the recent Ethereum improvement proposals, the IEPs. These were proposals that were brought out for account abstraction. There were proposals that were trying to enhance user experience and functionality on the Ethereum network. So, um, our research objectives majorly check out the cost benefit relationship of gas sponsorship at varying thresholds, analyzing impact of community provider behavior and setting shifting strategies on the account of action, providing actionable recommendations. So, check out on the okay, data sources, how are on-chain transactions, change analytics, historical gas prices, account of function data from the ERC 4337 implementation and comparative matrices between account abstractions and non-account abstractions research. Analytical approach involves comparative analysis of account abstraction versus non-account abstraction transactions, economic modeling of different sponsorship scenarios, trend analysis of user behavior patterns, and quantitative analysis of energy volatility. Checking out the feasibility of gas production, we got to see that uh, that one the realize that the gas production capacity is now the range of 120,000 to 250,000 in gas compared to EOA transactions that are at the range of 150,000 to 900,000 in gas. The gas prices fluctuate between 10 to 100 days for both account abstractions and EOA transactions. Secondary letter conjunction, the feasibility of that sponsorship. If you look at our chart, you see that there's a high prevalence in account abstraction transactions in certain range between transactions that involve $1,000 to $10,000. That's the trade size where higher prevalence, higher account abstraction transactions were noted, and larger transactions like from $100K and above have significantly fewer account account abstraction transactions. And we noticed also in our analysis, in our research, that account abstraction transactions generate higher volumes within the $1,000 to $10,000 range in portfolio. That's the chart for it here. Also, taking a look at potential sponsorship models, see that if we were to use a full sponsorship cover 100% of that all transactions, it gives higher user acquisition potential, but most expensive because it's talking about the cost 50 to 25% of the current pool program. And we tried the tiered sponsorship model, get full sponsorship in less than for transactions that are below $1,000. We'll get partial sponsorship, that's 50% sponsorship for transactions within the $1,000 and to $10,000. We have no sponsorship for transactions that are above $10,000 range, and it is the advantage of this is more economically suitable while targeting high investment. And we check how it helps them pay as PSS, PSS, free high concession payments, and provide stable budget planning. Now, I use that got to realize that the daily active account of remains daily basis. That's to say that every day there is a record of an account taking they remain consistent. So, cumulative AA wallets, that's the cumulative account of wallets. They over 400 plus last 90 days. And cumulative account for personal transactions, there are no between 5,000 plus in the same 90 days, in the same period. Also notice that the transactions totally is for transaction means that there will be a lot of transactions. Checking out the cost for notice that their sponsorship models range this spread of the protocol. The expected benefits from this is that there should be 30 small transaction volume should be a 15 20%. User acquisition, 10-20% growth in overall trading volume, and it should give a competitive advantage over other texts. Now, more on user engagement analysis. Charts here tend to show that really they show the more the expected that's the chart for assuming the 1058 then for the KA account transaction wallets is they have risen to 400 plus 200 plus wallets have been involved. Account abstraction wallets have been involved in transactions in the last 90 days. So when we come over to the MEV dynamic of account transaction, my colleagues Meji will handling it. So Meji, over to you. Meji, are you there? Can anyone?
Good afternoon, everyone. Uh, I'll be continuing from where my colleague at Donny stopped. So in our findings, we realized that we found out that account abstraction transactions are consistent and they have a lower average gas price. And while external transactions represented by the red lines in this chart here, they have higher prices, higher gas prices, and they are much more volatile. As we can see, they are much more volatile than account abstraction transactions. So, and the other charts, the 95th percentile analysis here confirms this pattern. This is simply saying that account abstraction transactions are less vulnerable to gas price manipulation. So then we move on to MEV dynamics for account abstractions. Then in the current MEV landscape, it is seen that sandwich attacks occur daily, and it peaked in the last 19 days on March 11th with a 22,000 plus attacks happening that day. And however, despite the large number of sandwich attacks happening daily, account abstraction transactions have experienced no sandwich attacks in the last 90 days. So to compare the gas price, account abstraction transactions maintain lower, more predictable gas prices, while EOA transactions are more volatile and they have extreme spikes. During network congestion on Ethereum, the gap between gas price for account abstraction transactions and EOA transactions widened considerably. So all of this data, the transformation they have for MEV strategies is one is reduced mempool visibility, where transactions signed off-chain can only be submitted when certain conditions are met. Then private order flow options, they bypass public mempool, custom execution logic with building MEV protection. So with account abstraction, Traditional sandwich attacks are more difficult, and front running based on gas price is less effective. However, new MEV vectors can emerge around sponsored transaction bundles. So what is the benefit of this analysis for retail users? One is reduced vulnerability to classical sandwich attacks, more predictable transaction execution, and lower costs, thereby improving accessibility for smaller traders. So for a more fair ecosystem, we have various concerns, and one of them is centralization risks of bundlers. That is, account abstraction users, they usually bundle their transactions. So the bundlers providing that service may get up to be like centralized. That is, one particular bundler can get a large percentage of account abstraction transactions. So our recommended gas sponsorship model for account abstraction is hybrid tiered approach, where small transactions that have less than 1,000 volume, they get full gas sponsorship. And the target for this is new users and retail traders. This is aimed to ensure Uniswap gets maximum user acquisition and engagement, while medium transactions, that is transactions between $1,000 and $10,000, they get partial sponsorship, that is 50%. And the target for this is regular traders and small LP providers. This is to increase trading frequency and volume, while large transactions, that is transactions above $10,000, they should get no sponsorship because gas costs present a small percentage of their transaction value. So this helps to maintain protocol revenue while focusing on high impact segments. So the implementation timeline that we suggested for account abstraction is for this study is phase one is divided into 3 phases, with phase one taking place within 1 to 2 months, with limited pilots where 2 to 3 high volume pools are selected and full sponsorship are granted for all transaction sizes with detailed metric monitoring. Phase 2 is a refined model where tiered sponsorship is implemented based on phase 1 learnings, and the recommended sponsorship model can be expanded to 10 to 15 additional pools and can be adjusted based on performance. The last phase of
Your time is up, so you can just round up. Thank you.
been start
All right. So you can stop your presentation. Thank you very much. Dimeji, are you there?
This
Dimeji, can you hear me?
so Q.
All right. Thank you very much, Dimeji. Okay. We'll go to team two. Team two will be presenting on quantifying LVR on Uniswap V3. Team two, please, you have 15 minutes. Thank you. Over to you, team two.
Hi everyone, good afternoon, good morning, good evening, where you're in the world. My name is Alfred, and with me here today is Kristen and Daniel, and we'll take you through quantifying LVR on Uniswap V3. So this will be the table of content of our presentation today. We'll start with an introduction of what this research is all about and the methods we followed, which we've taken through by Hobby. Then I will take you through our result and our conclusion. So our introduction. So what is Uniswap and what is LVR and this research about? So if you're not new to crypto, if you have been in crypto for a while, you could know that we have two types of exchanges. We have decentralized exchange and we have centralized exchange. Centralized exchange is like Binance, Bybit, while decentralized exchange are Jupiter and Uniswap. But our focus today is majorly Uniswap. And this decentralized exchange have transformed how digital assets are traded. We're removing the needs for intermediaries. So decentralized exchange works like it's like look at it like an online marketplace where people trade cryptocurrencies without needing a middleman like a bank. There's no stock exchange, there's no middleman. So instead of relying on a company to manage the trade, DEX uses smart contracts, which are self-executing computer programs that automatically process transactions. So imagine like a farmer's market where people buy and sells goods, which what the farmers produce, without needing a cashier, without having a cashier. That is how DEXs operate, and that's how DEX was. So it's like I call it peer-to-peer trading without a bank or a broker. So how does DEX work? So instead of matching individual buyers and sellers like I said, a traditional stock exchange, they use liquidity pools, which is like a pool of funds which are supplied by liquidity providers. And this pools allow trades to happen smoothly. So in a market, we have two types of people. We have the traders and we have the liquidity providers. So the liquidity providers provides the funds in which the traders used to swap. So you could imagine, I don't know if anyone has tried swapping, let's say Ethereum to USDT, and you swap in less than 3, 4, 5 seconds. And I've ever wondered, where did the USDT come from? It's not really from the exchange, just from a group of people or some people that have supplied a bunch of USDT to a liquidity pool because they have that USDT and they collect a fee in return for supplying amount of USDT. So what is LVR? So LVR is the difference between what a liquidity provider actually earns and what they can earn if they actively rebalance. So I'll give an analogy here. So imagine a street food vendor selling hot dogs in a busy street, and he or she set up their cart in a particular location selling hot dogs. And unluckily or luckily that day, there is a sporting event that happening few minutes from where they set up their hot dog vending machine, but they did not move their vending machine to the new location in which the sporting event is going to happen. You all agree with me that the hot dog provider will lose money that day because they did not move their vending machine. That's exactly what happened to. That's exactly what happens when a liquidity provider does not rebalance his or her trade while they supply liquidity. So if a given asset price move out of the chosen range, like I said in this analogy, their funds become inactive, like a food cart in a bad location. And if they don't rebalance, move their cart to where the busy event is, they lose potential profit. So that is what LVR is all about. We're trying to see the difference between what a liquidity provider would earn and what they should actually earn if they actively rebalance their trade. And we call some other people the arbitrage traders. So the arbitrage traders are traders that profit from this price movement. So from this price movement, the traders they profit from it, and LP will end up with less money if they have actively rebalanced. So why should you care about LVR? Why should everyone care about LVR? Liquidity provider must actively manage their position to avoid losses, and if they don't rebalance, they could end up less than they should have, which they don't want to be in a position of. So this is objective of our study. I want to see our three main research question when we started this study is LVR significantly different across trading pairs? How do the different features influence LVR, and how does market volatility affect LVR? We got our data from Flipside Crypto, and we used Ethereum because it's the chain with the most total value lock and it's actively traded. And we used a year time frame. I read the year time frame because of various reasons. Want to analyze market condition in both bull and bear season. I want to have a more dynamic understanding of LVR in its swap V3 to have a more reliable conclusion for liquidity provider. And we use Python for analysis for our visualization, while we use SQL to extract the data from Flipside cryptocurrency. So this is transaction count. Like I said earlier, we had 3 pool: USDC, USDT, ETH, USDC, and WP ETH. And what this diagram just shows is the number of transactions in each pool. As you can see, the green marks add high transaction count, and that's the USDC, USDT pool. What we notice is that most traders tend to lean towards this pool, perhaps because it's a stable coin pool and they're afraid of losing money. Followed by the ETH USDT, which is also a volatile pool, but it's not as volatile as the WBTC ETH, which had a lot of few transactions. And the next slide will be telling you about the methodologies we use and the method we followed well actively. Thank you very much.
Thank you so much, Alfred, for that wonderful introduction. Hi, my name is Christian. I'll take you through the mathematical definitions, the variables that we analyze, and some assumptions that we put in place for a smooth calculation. Next slide, please. Alfred, next slide. All right, thank you. So basically, this is how Uniswap V3 works. The liquidity provider provides liquidity in the pool and gets rewarded with fees. And for V3, they can provide liquidity to a certain range of price, right? For this pool that I put here is basically for ETH and USDC. So what it means is if the price of ETH goes below $3,000, their liquidity becomes inactive and they do not earn any fees. So when from the time of providing liquidity to the time of the end of a liquidity provider providing liquidity, so things happen in the pool. Basically, trade takes place and the pool becomes imbalanced. To calculate the LVR, we needed to understand the variance, the volatility, and the AMM price of the pool at every point in time. So basically, variance is just the measure of how much the prices fluctuates over time, and mathematically, volatility is the square root of variance, right? And to obtain the AMM price, so AMM price is basically gotten from the ratio of the tokens in the pool, right? So it's a mathematical calculation to get the price of each token in the pool, because there are 3 types of pools. You have the volatile pool, you have the stable pool, you have the stable volatile pool. Yeah, and to get the LVR, we analyzed some variables. So the first one we looked at was the pool total value lock. So basically, the total value lock is the value of the pool at any given time. Let's say, for an example, you put in 1,000 USDC and 1 Ethereum. So at the current price of 2,000 for Ethereum. The total value locked for that pool at that particular time would be 3,000 USD. So we have to still understand the AMM price versus the market price, because as trade occur in a pool, the prices of the token usually changes, and it causes a divergence between the major market price and the intermediate market price. So major market price is done with other books and oracles. Like for Binance, they have a different market price for each depending on the time. So the divergence is always caused during these moments of voluminous trades from an AMM pool to the market price. So swap fee is basically the reward that LPs gets for providing liquidity in a pool. So to calculate variance, I captured a part of our code in this slide, so you could see how we are able to obtain the variance and also obtain the volatility. So from our research, we found that LVR can be gotten from the volatility, from obtaining the volatility and dividing it by 8, right? So what we did was to get the log returns of variance in order to obtain our volatility. After this, next slide. Yeah, so the assumptions that we took, as I explained earlier, when trades occur in the pool tends to be imbalanced, and the pool needs to be rebalanced in order for LPs not to lose money. So what we did at this instance was to take the daily rebalancing of each pool in order to calculate for our LVR. And also, as I explained earlier, volatility is the square root of the variance, right? So we just did a log return as a proxy for the volatility because it's mathematically equal. Yeah, and this brings me to the end of my own presentation. So Daniel will take us on the results and the conclusion of this analysis. Thank you.
Okay, good day, everyone. My name is Daniel, and I'll just briefly share with us the results we obtained from our research. So for this research, we investigated 3 different pools: the ETH USDT pool, the USDC USDT pool, and WPTC ETH pool. So our research was basically to figure out if the LVR differs significantly across these different pools, and also find out how different fee tiers and market volatility affect these LVR values. So for the ETH USDT pool, the LVR values rallied around 2 to 4.5 basis points for this period of time. And what this means is that the losses liquidity providers incurred in this pool were much. So next slide, please. So if you look at the charts by the left, even after factoring in the fees earned by these liquidity providers, it was not still enough to offset the losses they faced in this pool, which is due to arbitrage impact on this particular pool. So hence we came to the conclusion that this pool was not a very favorable one for liquidity providers. Next slide, please. So the next pool we focused on was a stablecoin pool this time, the USDC USDT pool. This pool was a relatively safe pool to provide liquidity in, as both assets were almost at the same price throughout the period of time. And this, for context, this pool is operating on a 0.01% fee. So we found out that the LVR values of this pool were approximately 0 throughout the entire period of our research. And now the implication of this is that liquidity providers were able to get some profits from trading fees. And this pool turned out to be a lucrative one for providing liquidity compared to the ETH USDT pool. Next slide, please. Okay, we also studied another pool, this time a volatile pool, the WPTC ETH pool, and it's also a 0.3% fee tier pool. So the LVR values for this pool are also approximately 0. Now, if you look at the charts by the left, even after getting the fees earned by this pool, we found out that it was a very lucrative pool, as the fees significantly covered for the losses incurred on this pool. And now that brings us to our conclusion. Did we answer research questions? So at the beginning of this presentation, my colleague mentioned a few questions we were focused on during the period of this research. And the first one was, we're trying to answer the question of, do these different pools on Uniswap V3 experience different LVR levels? And we came to the conclusion that, yes, the case for these three pools were that for the ETH USDT pools, the LVR values were between 2 and 4.5 basis points, while for the WBTC and stablecoin pools, the LVR values were comfortably below 0 during this 1 year period. So the answer was yes. Also, we found out that the higher fee pools experience more dramatic LVR spikes relative to the pool's TVL. And also the charts show that price fluctuations creates more arbitrage opportunities, and hence market volatility also impacts LVR values for Uniswap V3 pools. This is the next slide. So yes, that brings us to the end of our presentation. Our code base can be found on Flipside, and the link to these reports will be shared immediately after the presentation. Thank you for your time.
Thank you so much, Team 2. Thank you so much. All right. Yeah, if you want to upload them, you can just use the emoji. Okay. We'll go to Team 3, and Team 3 will be presenting on LP profitability analysis on Uniswap V3. LP profitability analysis on Uniswap V3. Over to Team 3. Please, you have 15 minutes. Thank you.
Thank you very much, sir. GM, everyone. Good morning, good afternoon, good evening. My name is Chinonso Collins, and I'm representing Team 3, and we are looking at a comprehensive analysis on the LP profitability of Uniswap V3. So we're going to look at the executive summary of this, the introduction, the research objectives, methodology, the key metrics for analysis, the results, interpretations, and the summary of the key insights, and also a simulation analysis and recommendation with conclusions. So using Dune Analytics data, this study comprehensively analyzes the LP profitability in Uniswap V3. We examine the interplay between concentrated liquidity, fee tiers, trading pair characteristics, and market volatility. And the finding we found, out of the different things that were findings, we found that while higher fee tiers tend to increase impermanent loss, they can also result in higher net profits. Additionally, the effectiveness of concentrated liquidity strategies varies significantly with price movement. And also, we had a little 30-day simulation comparing LP trust strategies to simply holding the token to demonstrate how these factors interact to determine the profitability of the liquidity provider. So the introduction is that Uniswap, is a DEX that allows us to trade and swap cryptocurrencies without relying on any centralized platform, without any intermediary. Uniswap V3 was released in 2021 May, and it is the third version. And one of the significant differences is that the Uniswap V3 offers concentrated liquidity, fee tiers, and L2 compatibility, which maximizes efficiency and cost effectiveness. So we see that we already know that liquidity providers in Uniswap profit from trading fees, but they also face risks like impermanent loss, where price divergence reduces returns compared to holding the asset. And profitability depends on the trading volume, on the fee tier, and the pool type. When we talk about pool type, we mean that stable coin, whether is a pair comparing either pair of just stable coins or volatile pairs, which from this analysis we can attest that stable coin pairs yield lower, result to lower impermanent losses But when there are volatile pairs, it obviously can affect, it can give higher fees because of the trading activities, but also increases more risk. LPs can be profitable, especially in high volume and well-managed pools, but returns are not guaranteed. So we have these research objectives. The first one is to define metrics for profitability. The next one is to try to quantify the impact of concentrated liquidity on profitability. Then we also saw the try to achieve and try to check the role of fee tiers in profitability. And then the research objective is also about checking profitability across trading pairs and also the impact of market volatility. So the methodology used, we collected the data from Dune Analytics. We based our research on Dune Analytics, and we analyzed key metrics such as net returns, effective analyzed percentage returns, total LP trading volume, impermanent losses. And with these metrics, we were able to use them as building block for the analysis to turn our research into indicators that we can use to see how profitable LP providers are on Uniswap V3. So, okay. So as I said, the net profit, calculation of profit after losses, then annualized percentage return is a measure of yearly return. We, used a 7 days period to make the analysis on the top 100 pools, and the annualized percentage return is a measure of the yearly return on investment when assuming that that's how it continues for the year. And then effective fee APR, refers to the returns adjusted for time and fees, because based on the difference between Uniswap V3 and V2 is that in Uniswap V3, profitability is based mainly on positioning, and the effective fees, they don't earn, and a liquidity provider does not exactly earn every fee, but they earn based on their position in the market or in the pool. So we also looked at impermanent loss, which is the loss due to asset value changes in pools. So this is the loss that will be incurred if a liquidity provider closes his positions, and comparing this to the price of what he had if he had what he would have if he had simply held the token. So the results that with all those metrics, we're able to come up with a table. And in the table, we have a summary of the top 100 liquidity pools ranked by the cumulative trading volume on Uniswap V3. And the first thing that is seen here that when you look at the fees, the total fees and the net profit, you see that there is a difference with the total fees and the net profit. And this is basically based on how effective the fees were, based on the positioning, the effective fees, and the impermanent losses. So we can see the top pool pair, USDC WET, that despite generating a fee income of $356,000 over the analysis period, the corresponding impermanent loss of 304 from the effective fees reduced the actual profit to 226.3 thousand. And this reveals that without accounting for impermanent losses, profitability might be significantly overstated. So we also analyzed pools with similar pool pairs but different fee tiers to be able to ascertain the role of fee tiers in profitability. And the result shows that the higher the fee tier, the higher the impermanent loss and the potential net profit. As we see that USDC WET had the one with the fee tier of 0.30 being the highest was able to incur the highest impermanent loss as well, but also the highest net profit. So the key insights is that we were able to get these metrics, net returns, instead of just using fee metrics as the metrics for profitability, which provides a more accurate net profit measure by considering impermanent loss. We also used APR as a comparison tool to normalize returns across the pools of various sizes. We also considered the impermanent loss of offset, which revealed that impermanent loss fees in stable market periods, the fee earnings typically outpace the impermanent loss, creating positive returns. But however, during volatile periods, impermanent loss can exceed fee earnings, resulting in negative returns despite high fee generation. This pattern was particularly evident in pools containing Ethereum during price downturns, where impermanent loss frequently wiped out the fee earnings completely. So the key insights, we remember our key objectives. So one of our objectives was to check the impact of concentrated liquidity, and what we were able to ascertain through the average range effectiveness percentage matrix. It revealed a strong correlation between how effectively LPs position their liquidity, concentrated liquidity, and their returns. That when positioned with range effectiveness above 80%, they showed approximately 2.5x returns than those below 50% effectiveness, confirming that proper range setting is also crucial for profitability. And also, we also saw that the price range width relationship, which shows a clear trade-off between range width and returns. Narrow ranges exhibited higher potential returns, while prices remained within the range. But if the price is moved outside the bounds, it will actually suffer complete fee loss. It will not earn any fees. While wider ranges demonstrated more consistent but lower returns, highlighting the risk-reward balance LPs must consider. We also, the key insight in the objective of row of fee tiers in LP profitability, we saw that higher fee tiers in stable markets underperformed in stability, missing out on volume, while low fee tiers in stable market thrives in stability, attracting massive trading volumes. And then low fee tiers in volatile markets struggle in volatility, lacking sufficient revenue, while higher fee tiers in volatile markets excelled in volatility. So the best performing fee tiers depend on either market volatility and trading activity. So the key insight when achieving the objective of profitability across trading pairs, we saw that high in-range positions, we saw in the different trading pairs, it can either be a stable coin pair, just like USDC/USDT, or a volatile pair. When you talk about maybe Ethereum with Bitcoin, that's ETH/BTC. And then the difference is that stable pair coins, have minimal impermanent losses, have consistent APRs, and high in-range positions, while volatile pairs have high impermanent loss risk, but variable APR range, which could be high on very good conditions, but on the other side, the high impermanent loss risk is there. So we also, in one of our objectives, try to measure the impact of market volatility on liquidity providers, and we saw that narrow positions amplified impermanent loss despite low volatility, and proactive position adjustment can prevent impermanent loss during high volatility. And also, stable conditions reduce volatility and impermanent loss risk, that when the market is stable, that there is low impermanent loss risk, and then high trading volume high trading volume compensates impermanent loss in volatile markets. So when you're providing liquidity for a pool with high trading volume, it could compensate for impermanent loss in volatile markets. So the summary of the key insights is that, okay, before I continue, I would probably allow my subordinate teammate to continue with the summary of the key insight and also give us a rundown on the simulation analysis that was done. Thank you. So I can hand over to Dan now.
So good GM over here. Nice to have this opportunity to present this project that we have been working on. So I'll be sharing my screen now. Yep. So the summary of the key insight, just as Cruz has mentioned before. So the net returns versus the fee only metric. So this if the fee alone overstates the profitability, impermanent loss must also be factored in. So I would like to run this as fast as possible with all of the time we have left. So the impact of the concentrated liquidity on capital efficiency is also sorry for that. Okay, let me give a run through of the simulation first before we give the summary. So while we have seen how we have gotten the strategy for the profitability. We ran a simulation to see if investing in the pool is actually profitable in a real situation in the from the view of an investor. So the here we're actually looking at here is the USDCW THP. So, and this is a 30-day simulation if the investor have actually invested 30 days ago. And right here we are seeing that even though here the investor has actually earned fees on his invested $1,000.
Your time is up, so you just round up. The time is up, so you just round up. Thank you.
All right, thanks. So the apparent loss far outweighs the fees that have been earned, which made it actually into a negative profit and negative net profit, which shows that due to the downtrend of Ethereum in the past few weeks, it hasn't been profitable to actually invest in the pool. But when we compare that to actually holding tokens in itself, it is still profitable to invest in the pool than hold the tokens over the course of the time, since we're actually earning more fees on the funds that were invested in the liquidity pool. So if an asset has more volatile option, it would be more profitable to hold the tokens in itself. Meanwhile, if there is a downtrend, it will be a lot more profitable to actually invest in the pools than to hold the tokens. Meanwhile, if they are both stablecoin pairs, it would be more profitable to actually invest in the liquidity pool to earn more fees on the.
Thank you.
So
Thank you.
Okay, I'll give you.
Thank you.
Yeah.
All right. Thank you very much. In 3. Okay. So lastly, we're gonna have team 4. Yeah, if you want to appreciate them, you can just use your emoji and appreciate them. But lastly, we're gonna have team 4, and team 4 will be presenting on understanding impairment loss over time on Uniswap V3. Understanding impairment loss over time on Uniswap V3. Team 4, you have 15 minutes. Thank you.
GM guys.
Freeman, mute your mic, please. So if you signed in with two accounts, if you join me with 2 accounts, the echo would be there. So if you sign in with 2 accounts, the echo will be there. So you might want to log off from one, so you can prevent the echo. Thank you. All right. Freeman, you can go ahead. Okay, in case you are speaking, we can't hear you. Your time has started, though.
GM guys, can you hear me?
Yeah, we can hear you. Please go ahead. Thank you. Your time has started.
Sorry for the little interruption. So today we'll be discussing on a very vital topic, understanding of impermanent loss on Uniswap version 3. And yeah, we'll be talking about this topic that shapes the world of decentralized finance, the ups and downs of providing liquidity in Uniswap version 3. We'll look at how liquidity providers not only earn fee, but also are exposed to losing some values of their assets over time during this period of providing liquidity in the pool. So we'll be introducing all these contents. We'll be going down these contents one after another. Then at the end, we'll simulate with one user liquidity to better understand the impermanent loss vividly. So I would like my colleague to just introduce this topic. So we can have a kind of base ground to follow on. So Chooks, are you there?
Yes, I'm here.
Okay, please, can you just give us an overview of what impermanence law is, so we can.
All right, thank you, Apostle, for this opportunity to present as an analyst here. I'll take it on a part which asks us what is an impermanent loss. What is it all about? You know, by definition from our slide, impermanent loss is referring to the difference in value between holding assets in a pool against holding it in your wallet. That is, when you get assets in a pool means supplying liquidity for a certain pair. So what is impermanent loss? Impermanent loss, from the name, impermanent means something that is not that has not already happened. You get? So impermanent loss means if, for example, now what causes it is price changes, according to what you say. So when the price of an asset changes with respect to the other, so there will be a kind of rebalancing in the pool, which now causes an impermanent loss for the liquidity provider. So impermanent loss only occurs when the liquidity provider is still active. But when the liquidity provider is no longer an active provider of liquidity, that is when, from impermanent loss, it will now become realized loss. So now, the permanent loss is just something that, theoretically, it has not occurred, but it's just visible because there were changes in price. So the formulas written in front of us, the L equals the square root of X multiply Y. The L refers to an impermanent loss, like the loss. Y is square root X and Y refers to the product of the amount of tokens supplied into the liquidity. All right. So the impermanent loss is dependent on the token amount supplied into the liquidity pool, the product of the token amount. That is basically what impermanent loss is. Why? If you check the relationship of X like this, X is a token, Y is a token for in our case, yes. So the relationship of our X with respect to the impermanent loss means X equals L divided by square root of P. Now, what does P mean? P is price ratio. That is, for example, now let's go with its USDT pool to make it easy understandable. Now, price ratio means the base token, in our case here, will be it, right? All over, that is divided by the price of USDC, which is approximately $1. So now the price ratio of its USDC pool is, for example, the current price of it now is about $2,000. So the P now is about $2,000. So the relationship of the amount of token X in the pool is the loss over the square root of P. The same applies to the token Y. For token Y, is the loss multiplied by the square root of P. So this is all for my part of the presentation. So I'll give the mic over to Freeman.
So Chooks, thanks for the clear definition of impermanent loss. So I would like to add to the major cause of this impermanent loss in version 3. So which I tagged here as price divergence. So price divergence is referred to kind of a difference in price between two assets in the liquidity pool relative to their original price when liquidity was added. So it's kind of when token price increases or decreases significantly compared to when you added the liquidity in the pool, that's when impermanent loss kicks in. So Uniswap version 3 makes use of mathematical formulas to keep this balance. So it's a kind of they makes use of mathematical formulas in order to balance this token in the pool. As you can see here, the L here means the liquidity, then the X and Y denotes the virtual reserve, because we are talking about the Uniswap version 3. So the X and Y here are the are the virtual reserves, because Uniswap version 3 makes use of price range. So not all the liquidity in that pool are active. So the X and Y are the virtual reserves there. So we'll talk about concentration of concentrated liquidity, what it actually means, because that's where we will be driving out, so that we understand what impermanent loss in VP3 understand. So Uniswap version 3 kind of allows the liquidity providers to add their liquidity within a specific price range, rather than the whole price range as seen in Uniswap v2. So this lets a kind of make liquidity provider to add their funds where trades are likely to happen. And this helps in increasing capital efficiencies in the pool. So we understand that in V2, liquidity providers provide provides liquidity and in the pool, and that liquidity is spread uniformly across all the entire price range. But in Uniswap V3, it gives a chance, a kind of chance for you to specify where you will concentrate your liquidity, So going forward, we'll get to understand how this concentration of liquidity affects the impermanent loss. So the first one we have here is when your liquidity is within the price range you specify, so you encounter minimal impermanent loss. So when your liquidity, since Uniswap V3 gives a chance for you to add your liquidity within a price range, when the price is within this range you added, and the price fluctuates aggressively, aggressively, you will encounter impermanent loss, because we stated that impermanent loss is caused when there is price divergence. Now the second one is outside the range. So whenever the price of an asset, one of the assets in the pool, exceed your price range, which you specified, which you included when you were providing the liquidity, your asset is converted into one asset class. In as much as you provided two liquidity, whenever your liquidity crosses this range, your asset is comprised of one asset. So for instance, now, if you provided a liquidity for Wrap8 and USDC and specified a price range of $2,000. So if a price exceeds that $2,000, maybe the price crosses to 1,800, your asset in that pool will comprise of only one asset, and that asset will be the depreciating asset there, which is that Wrap8. We're still going to understand this thing vividly. So we pointed out one user that deposited in Uniswap version 3, so that we can better understand how impermanent loss is achieved is being realized in Uniswap v3. So this user deposited in the pool at USDC and deposited it of 0.99 with USDC of 2,900. Then now he specified a upper range of 4,998 with the lower range of 2,998. What this thing means is that his liquidity is only active at this particular price range. Whenever his liquidity exceeds this price range, the liquidity will no longer be active, and he will no longer be any fees in that pool, and his asset will comprise of only one asset class. Now, the price at which he deposited the liquidity is $3,000. So let's understand this. I don't know if people can see this thing very well. So this is a simulation of his asset in the pool, and hypothetically holding the asset. This is if the liquidity provider had held onto his asset, this is what it would have worth. Now, this is the asset in the pool. Now, this is the pool value USD. That is the USDT in the pool. this is the Ethereum in the pool. That is the provided Ethereum in the pool. Now, this column states the impermanent loss of this user. And now this is the net position. Now, coming here, we have the upper range which this user specified, and this is the lower range, and this is the variance of Ethereum prices. So we're taking this, for instance, if we get to row six, when price is as $4,771. Remember that this user specified his upper range at 4,998. We understand that even when the price is within your range, because looking at this, the price is within the range. The upper range is 4,998 and the lower range is 2,499. And the price has diverged from the original price which the user specified. We understand that this user specified provided liquidity at 3,000. So at this point, the price has diverged from the original price. So impermanent loss has kicked in. He realized $154. Despite earning fees, he had earned $40. So you can understand that even earning fees, the impermanent loss has not been offset. This is his net position. If you take a look at other, let's take a look at another instance. Take a look at another instance. Okay, let's come to row 10. The price has also diverged. So, and we stated that whenever there is price divergence, the impermanent loss will kick in automatically. And this user realized impermanent loss of 164. Now, another concept we discussed about is we say that whenever a price crosses the specified price range, the value of a user will contain only one asset class. So if you take a look at row 17, this user specified a lower price range of 2,499. Okay, 2,499. Now the price has diverged. The price has crossed this lower range, which is 2,446. If you come to this side, you see that this user has no USDC in this pool. His assets only comprise of 4 Ethereum, which worth 4,943. And if this user had held onto his liquidity without providing it in the liquidity, his assets would have worth 5,444. But since this asset is in the pool and the price has diverged out of the specified range, he has only Ethereum in the pool. And we have to understand that once the price exceeds your specified range, that is where the impermanent loss will be maximum. If you take a look at the impermanent loss, if you compare the impermanent loss the user accumulates incurred when the assets diverges outside of the specified range, you see that the impermanent loss there is kind of much. You realize $1,100 here. You realize $1,498 here. You see that whenever price of any asset exceed your specified range, your liquidity first is inactive. Not only inactive, your liquidity, you'll be kind of getting much impermanent loss. And even the accumulated fees which you have gathered in the pool will not be able to offset this impermanent loss here. So what are the methods for us? Let's take a look at the price, the relationship between the price and the impermanent loss. You understand that this chart, the impermanent loss tries to follow the pattern of the price, meaning that whenever there is price divergence, the impermanent loss will kick in, and the impermanent loss is at maximum here when the price exceeds the specified range which the user has specified. So a kind of once ever there is price changes, there will be impermanent loss in the pool, and the user will accrue losses. So we also have to state that this impermanent loss, as the name states, when the price go back to the particular price the users at which the user provided this liquidity, there will be no loss. So that is why it's called impermanence, something that is not kind of permanent. So, but if the price diverges and the user removes the liquidity, the user will realize this impermanent loss. So going forward, we'll stated how a user can mitigate this impermanent loss. The first one is we talked about actively managing your pool and kind of rebalancing your positions. Yeah, in Uniswap, you can add your liquidity. You can extend your price range. So this involves kind of managing your position so that you will not incur much losses in the pool that you're participating in. So the second one is earning high fees to offset impermanent loss. So this one means that a user in Uniswap version 3, there are types of fees ranging from 0.3, 0.05, and 1. So in order to maximize your fees, which you get, since the impermanent loss is mostly in pools, so you have to go for a pool that has higher fee, so that you kind of accumulate much fees to offset your impermanent loss. Now, the third one here is providing liquidity in more stable assets. We understand that providing liquidity in kind of stable pools, like stable coins pool, will incur less minimal impermanent loss. So I think we analyzed and found out that providing this liquidity in that particular
Your time
asset,
is up, please. So you can
okay,
just round up. Thank you.
okay, providing liquidity in more stable pools can kind of minimize the impact of liquidity impermanent loss the user incurs. So our conclusion here states that impermanent Uniswap v3 does not actually solve the impermanent loss. Rather, it's when a position is not actively managed, the user can incur impermanent loss, because when a price diverges out of your price range, stated price range, the user will incur much impermanent loss there. So this is our code base, which contains the queries that we've had. We also have all the queries that contains the impermanent loss in different pools. So maybe after I will share it. Thank you, guys.
Thank you. Please, let's appreciate all the team. You know, they put in so much work, and beyond this presentation, each and every team have a full report which would be published and shared on Monday. So to everyone who have registered for this meeting via email and all, it will be shared. And those who are following us on Twitter, it will be shared as well, so you can always get a notification to access the full research report. Thank you so much to all the team. Yes, so it's about that time where we now have our judges, you know, would be giving us, be speaking on their observations, um, you know, commendations, and areas of improvement for each of the team, right? Um, so, I have the opportunity and the privilege to bring Sam. Yeah, Sam, who is the analytic engineer with Flipside, is one of the judge, and also we have Florin, who is known as Boxer on Twitter, who is the developer relations from June. Okay, so yeah, so let's have Sam share with us his
Hey,
feedbacks. Yes.
hello. Yeah, thanks for all the team's presentation. Should we go like team by team, or should I just share feedback for all the teams?
Yeah, so I said yeah, preferably team by team.
Okay. I guess team one on account abstraction. I felt like the research question is supposed to touch on liquidity providing. So like how does account abstraction, you know, sponsored gas and whatnot affect people's behavior to actively manage their position on UniV3? I felt that was the research question, but it seems like the team direction seems to be more transactions in general. So I think that was what I think that's my biggest feedback on that presentation.
Yeah, you can go. You can go on. You can go on.
Oh, so like
Okay.
team B?
Okay. 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 So let me since you've given us feedback on team one, let me allow Florin to give us feedback also on team one.
Yeah, sure. What do we start with? I think on the methodology, I didn't understand how you guys even defined AA wallets. I think it's always very important to be very clear in all of these data analysis topics, like what is your methodology and how exactly do you define things. So it's like you could kind of like there's a lot of ways to define AA wallets. From the presentation, it wasn't clear how would you even find those and what's the scope that you include, because there's like I think you mentioned a few EIPs, but it wasn't really clear like what you included, what you didn't include, because there's like multiple different AA abstraction models. And then I think just more generally, it was like not clear from the presentation which chains you guys actually looked at. I would assume Ethereum, but it's like this could have been all the networks. Then there was a slide which included like a bunch of transaction buckets. And it's like, okay, how do you even count a transaction? Like do you count the swap volume? Do we count the liquidity provision volume? Do we count I don't know, like any of those things? Quite unclear. And then I think that there was like a bunch of segments on gas prices and how account abstraction wallets I don't know, use different gas prices. And it's like I didn't really follow the conclusions too much. I think it's just like, okay, the paymaster, or like I don't know which model of account abstraction models we're actually looking at, so it's hard to kind of model this in my head right now. But usually it's just the paymaster is a smart contract or a computer that batch executes transactions somewhere. So it's like it usually has a better pricing model than the individual user sending transactions. So it's like kind of like from that assumption, a lot of the downstream assumptions then are kind of meaningless to me, because it's like, sure, the paymaster is going to be better at pricing transactions because it's like a team hopefully has developed an algorithm to like or like a mechanism to find the best gas price at the moment. So yeah, a bunch of like specific feedback there. I think I will stop here. If the team wants, I have a bunch more notes, which I could give you after the after this.
Awesome. Thank you very much. All right. Sam, yeah, please, you can go ahead to give us feedback on team two.
Okay, so I think team 2 presented their objective pretty well. Delivery was pretty good as well. Kept it under time as well. The only thing I feel is the actual meat of the presentation. Like the topic is on loss versus rebalancing, right? I felt that the data
No,
that was
team
looked
two
at.
is quantifying LVR.
Yeah, so
Yeah,
loss
yeah,
versus
yeah.
balance.
Okay.
Yeah, so
Yeah.
most of the meat isn't about rebalancing. It seems like you guys are looking at impermanent loss instead, not like loss versus actively rebalancing position. I think that's a completely different thing than IL, right? So yeah, overall good presentation, but like the meat itself, I feel is a bit off.
Yeah, I can
Awesome.
say
Thank
that.
you.
I really liked the intro, the context setting. That was really good. The analogy was hilarious. A bit far-fetched, but I think it got the job done. This was the hot dog stand analogy. Objective and kind of data sources, super well laid out. But yeah, I kind of share Sam's feedback where like I kind of lost you on like the actual like what did we research and what did we find. I think you could have included some kind of equation like the last team did on like how do we actually calculate LVR. And then it also wasn't clear to me if I think there was like like one small sentence somewhere that like you assume that a liquidity provider would rebalance daily and then you made the calculations that way, but it wasn't super clear from the presentation, and especially like a core assumption like that, just work that out repeatedly so the audience can follow. But yeah, overall, well, really well done. At least from the presentation. And in the research department, maybe put in a few more reps.
All right. Thank you. Yeah, from feedback on team 3.
Yeah, I think the beginning for Team 3 was really good as well. Overall, very clear. But similar to Team 2, I felt that it's a bit off. Maybe because there was just too much things. It seems like you guys were headed in one direction, and then towards the end, there's like many different branches you guys were talking about. Like it started off with profitability, and then somehow it turned into like proactive position adjusting. Like where did that data come from, right? I just look at data around profitability in the beginning, but then suddenly at the end, there's something about like, oh, by the way, people who proactively adjust positions, this is our finding. Like, huh? You know, that's what I felt.
Yeah, Boxer, go ahead.
Yeah, pretty good intro. A bit chaotic. I felt like I think that there's a bit of stringency that could have been improved in the intro. But overall, pretty good. And then for the results, throwing one giant table at the audience is never to be advised. We have developed visualizations for a reason, so try to use them where it's applicable. So instead of throwing one giant table at me, maybe split that out into 3 charts or 3 graphs. I do see how a table is relevant in this context. But then if you really want to do a table, just like give me 4 rows or something, so I can at least kind of like see what's happening. And I don't have like, I don't know, this was probably like 100 data points thrown at me. Just makes it really hard to follow. Then again, on the methodology, it wasn't like super clear to me how you calculated. I think there was like APR numbers and effective APR numbers and impermanent loss calculations and stuff like that. It's like I would assume that it's like the average LP's values, but that is an assumption that I'm making. Like I don't know this during the presentation. And in general, I think during these LP analysis, it's like it's actually quite relevant to be like, okay, we're looking at LPs who are rebalancing often, and like you could have kind of made buckets of like, hey, these are kind of like set and forget LPs. They're never rebalancing. They're just like in this position and they never do anything else. These are like kind of active LPs. They rebalance every few days. And then there's like super active LPs, which are like rebalancing pretty much every 5 minutes. I think that could have been an interesting kind of angle on analysis. The space of LPing is so large and so diverse, and there's so many different players from like retail to basically like hedge funds who are like competing in there. So just doing like a general kind of LP profitability analysis, I think kind of like it's not very meaningful data to me, because it's just the space, it's very large, and like what are the strategies that are actually being chosen. I don't know, it doesn't tell me much. And then on the last thing, I think there was a simulation, and like you can't I think it's like not very meaningful to run a simulation on 1 month of data where the market has a downturn. Like the simulation will obviously be dependent on the market data. So it's like, sure, like maybe within the scope of this presentation, it's too much to like look at 12 months of data. But like what I would like to see is like, okay, can you do a simulation over 12, like 1 month, and then just have that 12 times over like the last year or something like that, where it's like you have different scenarios, because this is, yeah, the market has a downturn. Sure, like now the position is worth less in the end. Like I don't know. Didn't make a lot of sense to me.
All right, thank you. All right, Sam, Team 4, your feedback.
Team 4, yeah. So I think it started out good. You explained about impermanent loss, but I think the explanation got carried on for a bit too much. It felt like you were just repeating the same points over and over again. The main part of your research was that table, right? Looking at all the individual positions and the ILs. I feel like that's a good starting data, and you could have done a lot more based on that. Like the table itself probably should be your intro, and then the meat of your presentation could be something else, right? Could be looking at, like what Boxer mentioned, looking at IL across different periods of time based on market volatility, right? Different pools. This is talking about like other teams as well. Like most of you guys look at stable pools. Like I don't think there's any ILs there, right? I think the focus should be on non-stable pools and whatnot. But yeah, for Team 4, I feel like you were scratching the surface. There's a lot more things to uncover.
Yeah, Team 4, finally some formulas. I was really excited to see those, and I think the general kind of context setting, explaining Uniswap v3 dynamics and like how LPing works and stuff, really well done. But then yeah, it's like you kind of ran out of time to get to like the actual research. So yeah, a really good start. But yeah, maybe do time yourself on these presentations and make sure to not spend all your time on the introduction. This was really well done. You guys understood like the assignment really well of like introducing all of this. But then yeah, the actual research questions, I don't feel like I learned too much there.
All right, thank you so much. Thank you, Sam. Thank you, Florin, for your feedback. So I believe that each of the team are taking notes and would put this into consideration in any of the future presentations. All right, I would just want to hear some maybe closing remark for the team and for the program going forward. I'm starting with Florin and then Sam.
Yeah, overall, I'm always excited to see new analysts coming up. We all started somewhere. I think this is like very promising research from all of the teams. It didn't seem like you guys were too much like constrained by the data, but rather like the problem of being a Web3 data scientist is oftentimes that you do the data engineering, the data science, the data analysis, and the actual storytelling. It's kind of like you need the full stack. So it's like it takes a while and it takes a lot of repetition to kind of build that full skill set. So even though I'm German, I'm super direct. So like don't take any of my criticism too harshly. I really appreciate all of your guys' work, and I'm just trying to be honest to advance you. And like all of this has been really cool to witness. I think in general, just like be very specific about your methodology, your research, your data sources, what you're trying to analyze, and like all of this is like you're analyzing data, and the assumptions that you're making is like every assumption can really influence the outcome. So like when you're trying to present anything, you need to be very specific about what kind of analysis you've conducted, so the audience can follow your train of thought. So yeah, that's kind of yeah, that's my 2 cents here.
Right. Thank you so much. Please let's appreciate Florin for that. Thank you. Okay, over to you, Sam.
Yeah, I'd like to echo Boxer. I feel like a lot of comments we are nitpicking, but that doesn't, there's a lot of good stuff that you guys are doing. Also, I want to say that these topics are really hard, like extremely hard. And so 3 weeks might not even be enough to cover this in a comprehensive manner. So, I would suggest to even, pick like a very small portion, make it very clear what that small portion is, and go extremely deep in it rather than trying to cover all bases. That way, your takeaways will be much clearer to the audience. Yeah, it's just much more focused, much more easier to understand, given how complicated these topics are.
Thank you. That was a very much needed feedback. Thank you so much, Sam. All right. Interestingly, we are bringing the session to a close. It's been a very interesting journey. Exploring this part for 5 weeks, and I want to give a special shout out to Brandy. I know he's on the call, and Christian, who were instrumental in helping to mentor and guide each of the team in their preparations. All right, thank you so much, Chris. Thank you so much, Brandy. Okay, thank you so much, Florin. Thank you, Sam. Thank you to all the team who has invested their time in this. We would also be organizing one more Presage Labs, and also factoring in some of the feedbacks we've gotten from our judges, and that will be holding in the 4th quarter of the year, so that we can have time to prepare, and if we can get rewards for the efforts of the analysts, likewise. All right. So thank you very much, everyone, and I wish us all the best. So the presentation, the reports would be published on Monday and will be shared with us. Thank you, everyone. Thank you, Sam. Thank you, Florin.
Thanks, everyone.
mostly.